The escalating issue of student loan debt in the United States has drawn significant attention over the past few decades. With current estimates placing the total student debt at over $1.7 trillion, the ramifications of this financial burden extend far beyond individual students, affecting the economy, housing markets, and overall societal well-being. As the crisis continues to grow, it becomes imperative for policymakers, educational institutions, and individuals to explore innovative solutions to resolve this pressing issue. To fully understand the complexity of resolving student loan debt, it is essential to recognize the factors that contribute to its growth. Rising tuition rates, insufficient state funding for public universities, and a lack of financial literacy among prospective students all play significant roles in perpetuating this cycle of indebtedness. For many students, taking on substantial debt feels like the only viable option for pursuing higher education. Consequently, the narrative of higher education as a pathway to socioeconomic advancement has become overshadowed by the reality of long-lasting financial strain. One potential solution to alleviating student loan debt involves increasing investment in public education. State and federal governments must prioritize funding for public institutions to make higher education more accessible and affordable. By bolstering state financial aid programs, simplifying the free application for federal student aid (FAFSA), and enhancing funding for community colleges, policymakers can help lower the overall financial burden on students, particularly those from low and middle-income backgrounds. This investment could subsequently lead to a more educated workforce and, ultimately, a more prosperous economy. In addition to increasing funding for public education, reforming student loan practices is crucial to alleviating existing debt burdens. Current student loan structures often favor private lenders and impose unfavorable interest rates on borrowers. Transitioning to a system that provides more favorable repayment terms, such as income-driven repayment plans and interest rate caps, could significantly ease the financial pressure on borrowers. Moreover, a more transparent approach to student loans, where institutions are required to disclose anticipated repayment rates based on graduates' future earnings, would ensure that students make informed decisions regarding their financial investments. Furthermore, loan forgiveness programs have emerged as a potential remedy for those who have already incurred substantial debt. Public Service Loan Forgiveness (PSLF) program, for instance, offers relief to borrowers who commit to working in qualifying nonprofit or government jobs. However, the program has faced criticism for its complexities and low approval rates. Reforming and expanding these loan forgiveness initiatives could provide meaningful assistance to countless borrowers, enabling them to focus on their careers and contributions to society without being hampered by overwhelming financial obligations. While governmental and institutional changes are essential, individual borrowers must also take proactive measures to manage their debts effectively. Financial literacy programs aimed at equipping students with the knowledge and skills necessary to navigate their financial obligations can empower them to make informed choices when it comes to loans. Institutions can partner with financial literacy organizations to offer workshops, counseling, and resources, which will equip students with critical tools to understand interest rates, loan terms, and repayment strategies. Importantly, addressing the student loan debt crisis requires a holistic and inclusive approach that considers the unique experiences of various demographics. For example, marginalized communities often face additional barriers to accessing financial resources and educational opportunities. Policymakers must prioritize equity and inclusion in their strategies, ensuring that solutions are designed to support those most affected by systemic inequities. As such, targeted programs that focus on minority and first-generation students can play a crucial role in ensuring that everyone has an opportunity to thrive without the burden of insurmountable debt. Moreover, collaboration between the federal government, state entities, and private sectors is vital for developing comprehensive solutions to the student loan crisis. Partnerships that leverage resources and expertise from various stakeholders can lead to innovative approaches addressing different aspects of the problem, from financial education to debt relief initiatives. These collaborations can foster greater accountability and efficiency, ensuring that the solutions implemented meet the diverse needs of student borrowers. Any resolution to the student loan debt problem must also consider the larger social implications of higher education. As the job market evolves, it is essential to reassess the relationship between a college degree and employability. Increasingly, vocational training and alternative paths to career success are becoming recognized as viable options. By diversifying the narrative surrounding higher education and acknowledging multiple pathways to success, society can alleviate some pressure on traditional college enrollment. The specter of student loan debt has emerged as a formidable challenge for millions of graduates across the United States. With the total student loan debt surpassing $1.7 trillion, it has become imperative to explore viable strategies to alleviate this financial burden. Examining the multifaceted nature of student loan debt, the reasons behind its exponential growth, and potential solutions that can be implemented at both the individual and systemic levels. Ultimately, addressing the student loan crisis requires a comprehensive understanding of its complexities and a commitment to reforming the educational financing landscape. The magnitude of student loan debt is not merely a statistic. It represents a profound societal issue that affects the economic mobility of an entire generation. According to the Federal Reserve, approximately 45 million borrowers are encumbered by student loans, with the average debt per borrower hovering around $37,000. This financial strain often leads to significant life consequences, including delayed homeownership, reduced savings for retirement, and diminished investment in entrepreneurial endeavors. Furthermore, the burden disproportionately affects marginalized communities, exacerbating existing inequalities and limiting access to higher education. Several interrelated factors contribute to the soaring costs of higher education and, consequently, the burgeoning student loan debt crisis. First, the rise in tuition fees has outpaced inflation for decades, driven by decreased state funding for public universities, increased administrative costs, and the expansion of amenities that cater to student lifestyles. Additionally, the availability of federal student loans has inadvertently contributed to tuition hikes, as institutions raise prices knowing that students can access easy credit. This vicious cycle creates a paradox where access to education becomes increasingly unaffordable, resulting in more significant debt burdens for students and their families. To effectively combat student loan debt, a dual approach that encompasses both individual strategies and systemic reforms is necessary. On an individual level, students and graduates can take proactive measures such as financial literacy education, which empowers them to make informed decisions about borrowing, budgeting, and repayment. Additionally, income-driven repayment plans can provide borrowers with manageable payment options tailored to their financial circumstances, reducing the risk of default. On a systemic level, policymakers must prioritize reforms that address the root causes of rising tuition costs. This includes increasing state funding for public colleges and universities, implementing cost control measures, and exploring alternatives to traditional degree programs, such as vocational training and apprenticeships. In conjunction with individual and systemic approaches, student loan forgiveness programs and targeted legislation could play a pivotal role in alleviating the burden of student debt. Proposals such as broad-based student loan forgiveness, which has garnered significant attention in recent years, aim to provide financial relief to millions of borrowers. Additionally, legislation that addresses predatory lending practices and enhances consumer protections can safeguard future students from excessive debt. While these proposals face political and logistical challenges, they represent a critical component of a comprehensive strategy to address the student loan crisis. In conclusion, the student loan debt crisis presents a complex challenge that requires concerted efforts from individuals, educational institutions, and policymakers alike. By understanding the factors that contribute to rising educational costs and implementing viable solutions, we can create a more equitable and sustainable financial landscape for future generations. Whether through enhanced financial literacy, systemic reforms in higher education funding, or targeted forgiveness programs, addressing student loan debt is not merely an economic imperative. It is a moral obligation to ensure that education remains a pathway to opportunity rather than a source of financial despair. As we navigate this labyrinth of debt, it is essential to foster a collaborative dialogue among stakeholders to pave the way for a brighter, debt-free future. If you found this helpful, don't forget to like, subscribe, and hit the bell so you never miss a money tip. Drop a comment below with your thoughts or questions. I'd love to hear from you. Until next time, stay smart, stay savvy, and keep building your financial future.